Hello everyone, and we are on lesson 6 of the meme coin trading school. We right here have our forex chart open, so I want everyone to open up a coin, get out your notepads, find a good coin, just a good market, with a decent market right here like this, with decent chart I mean. And we are moving on to intermediate. For meme coin trading, we're going to be looking at chart work and trading strategies to use while you're trading. You can start placing your trades. We're going to do this in multiple parts as this is going to be a very long video, and so will the other parts. So in this video, it will be about technical indicators and how you can use them to give further confidence in your trade. So first of all, you will have a volume. That is a technical indicator as well. And then you have your charts. So our first indicator will be the moving average, the exponential moving average. Where are we going to add that? So on your page you have the buy sell, as you know, and then on the top right here you're going to go to FX indicators and type up moving average. The only one you will want is the moving average exponential, EMA. Okay, so what is a moving average? Moving average is a trend following indicator that smooths out price data pretty much, as you can see. Helps traders identify the direction of the market. In meme coin trading, where volatility is high, moving average are used to filter out market noise and highlight the overall trend. So EMA gives more weight to recent prices, making it more responsive to latest price actions. So how would you apply this? So in uptrend, if the price is trading above the MA line, it typically signals an uptrend, indicating a potential buy signal. So as you can see, it is trading above the line, means there is more of a buy pressure where you could buy right here. So you can see, let's just zoom in right here. Price starts to trade above it and the price is moving up. And now let's go over here. The price moved below the moving average and it's on a downtrend. So that is pretty much it. And we can see in the past right here as well, the price is trading below the moving average, so the price has decreased. This in itself is nearly a 2x, but we cannot sell in markets. So let's go back to about here. Let's find. All right, here we go. It's trading above the moving average, 134k, and it goes all the way up, keeps trading to about 50k. That's nearly a 2x just there. And it decides to go below the moving average for a little bit, and it goes back up, and we're at 60k. So you could have sold here, and then you bought here again, right here again, and you could ride it all the way up to the 60k mark, along with your other analysis. You don't always rely on technical indicators. That's something I have to tell you. Don't always rely on them. It is just to build confidence in your trade. So for a downtrend, it's just below the moving average. For the uptrend, it is above the moving average. Price trading. Okay, let's move on to the next, which is a Fibonacci retracement. So how will we find a Fibonacci retracement? Let us show you. So instead of forex indicators, you want to go right here, go to Gann and Fibonacci tools, and you click Fib retracement, and you get this big old chart right here. Like, what is that? Wow. Okay, let's just delete that for a second. Let me explain what Fib retracement is. Fibonacci retracement is a technical tool used to identify potential reversal levels in price movement. It helps meme coin traders determine key levels where the price could reverse or continue within a trend. How do you apply it? So, how do we place a Fibonacci retracement? So what you would do is you'd go over to this left tab right here, go to Gann and Fib retracement, and click the Fibonacci retracement tool. So let's just drag it out for 1 second. Don't worry about it. We're just gonna edit it. So you go from the low. If you're on an uptrend, which we obviously will be doing because you cannot trade on the sell side for the meme coin market. So you go to the swing low and set it at the swing high, the highest in the uptrend. You could either put it anywhere. So let's just say that is the all-time high. So let's just drag it all the way down here. Or just keep it up. It's perfectly fine. There's no difference. There we go. Just like that. Okay. So now that that's placed, you can see every area on the Fibonacci retracement is acting like a support and resistance. It is key zones where the market can reverse or hold as resistance, and you can find good entries in these zones. You can put it together with all your technical indicators, your buy volumes, and whatever you're thinking. So you can see right here it's resisting at this level. You can see right here it's holding the support. It's not really dropping too below. That means it could be a potential buy. As you can see, the moving average, the EMA, is trading above at this point, so you probably buy here, and then you could probably hold it up. It breaks that level and it starts to trade below. You would sell here. Short profit, not too much, but that's what you do in day trade. You can see over here again it's resisting. So Fibonacci retracement is simply just a indicator that shows you key levels in the market. You can use it for many things to find entries and exits, as I just showed you. Remember to trust in your trade. When price respects a Fibonacci retracement level, it aligns with moving average or support zone. It provides strong confidence that the price may bounce or reverse at that level. This convergence of indicators strengthens your trust in trade decision. So now we are going to move on to our next indicator, which are Bollinger Bands. So let's show you. What you have to do is again go to FX indicators, search up Bollinger Bands. You want to click this first one right here. Whoa, what is this? You get all of this blue, your chart is looking all crazy right now. So let's delete the Fibonacci retracement for now. Actually, we can hold it here. It's perfectly fine. Let's keep that below just there. There we go. Okay, so we are at Bollinger Bands now. So what's a Bollinger Band? Bollinger Bands measure market volatility and provide high and low points based on the price's standard deviation. It consists of a middle band, 20-period moving average, and an upper and lower band that just adjusts with the market volatility. So as you can see in the Bollinger Bands right here, we have the orange line, which is the Bollinger Bands moving average. It's the same as the other moving average. And you have the upper and lower bands right there. Well, how does it work? The wider the bands, the higher the volatility. The narrower the bands, the lower the market volatility. Volatility is how fast the market is moving. You can see the bands are very narrow here, so it's not moving too fast. But if we move to right here, you can see how wide it is. You can see the market is moving very rapidly. Look at that. But again over here, oh my god, let me just lock this. 1 second, guys. There we go. As you can see, it's very wide over here, so the market's moving quick. Very wide over here, very volatile market. Okay, how do you apply it? So overbought is when the price touches or breaches the upper band. It signals that the market might be overbought, meaning a potential sell or exit. Overbought, an example is right over here. You can see it's overbought, and this would be a potential to exit the market as it starts to drop right there. Overbought again right here, you can see it's a potential to leave the market as the price decides to sell off. Let's find an oversold now. When the price touches or breaches low band, it signals a potential buy or entry as the market is likely oversold. So let's go and find a potential entry. So let's see. over here is oversold, oversold. As you can see, the market reacts straight away, all the way to the top. Goes up, 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 just like that. And if you would have found an entry in either one of these, you would have sold at profit here, as this is a previous Fibonacci retracement level, and you can see it is overbought here, and you would probably find the exit. It is a short trade. You're not looking at high X's, you're not looking at crazy percents. This is just small trades. But if you were to look at the long term and find a perfect entry, because you would not be trading this entire market up, down, up, down, up, down. You would only be looking for a good entry and exit. So let's see, what can we see here? The market is oversold here, and you can see this is our start of a low. Market is overbought. You would buy, you would hold all the way to the top, and this would be a good trade right there. That'd be about 3x, but maybe you didn't buy there, so you found the fib retracement, you dragged it up, and that's obviously swing high and swing low, so you can't really do that because the market hasn't moved to that point yet. So let's see where we would find it. This is a good trade, so the market's already moved up to the high. You find a low right here. This is below the Bollinger Bands. The moving average looks good as well. Histogram down here, which is the market volume, looks good as well. The market is trading under the moving average, below the Bollinger Band, which is oversold. It's a good entry. It's on a Fibonacci retracement level. Good entry for you. You'd enter right here, you'd hold for the market, and you would sell at the reds right here where it is overbought, just like that. That is a good level. You could either find a level here, you could find a sell-off here. Either of three of these could be a good take profit, as the market already has made its move and you missed it, but you can still make a profit on the sell-off. So on to the next volume profile. So the volume profile is something you have at the beginning. Right here when you start, this is your volume profile. All of this is a volume profile. So what is all of this? Looks like a massive, oh, there was a massive move right there. So you can see the market reacts. The chart reacts, look like a bar chart, doesn't it? So the chart reacts whenever the price moves very high or very low. This can show you how volatile the market is and if it's moving fast or slow, or if there are any big moves. So what you would want to look for is prime action like this, where the market is moving very, very fast. That means the market's moving up, down, up, down. It's a good time to trade, but when the market is moving very slowly, like over here, you can just tell it's reacting very, very slowly, just moving pretty much parallel. It's not really moving fast. As you can see, the market spiked to this. The histogram reacted. Big sell-off and relax in price action right there. It is something you don't have to add, as every chart on Bullex, so when you open it, has this already opened up. And how would we bring all of this together? So, trusting your trades with the moving averages confirms the overall trend. The Fibonacci retracement pinpoints key levels where the price may reverse or continue. Bollinger Bands help gauge volatility and overbought and oversold conditions. Volume profile validates strong price levels based on real trading activity. When these indicators align, they give you a strong framework for making informed trade decisions. For instance, if price bounces off a Fibonacci retracement level, while the Bollinger Bands indicates it's oversold and the volume profile shows strong support at that level, you have a solid case for a buy. This convergence of indicators builds confidence in your trade execution and helps you handle the volatility of meme coins with more structured and strategic approach. That is about it for lesson 6, part 1 of lesson 6. This intermediate section will be very, very big. hopefully you have written enough notes and you can show in the chat some examples of a buy or sell or an overbought position or an oversold. And if you have any questions, just ask in chat, rewatch the video. But I will see you in part 2 of the intermediate section, guys. See you.